Welcome to the second episode of this series of the Basics of Stock Market series. If you're liking it so far, make sure that you hit that like button so I know that it's going good. And if there's something which isn't really working out for you, just comment it so I can keep in mind, improvements for the next episodes. Anyway, though, today we're going to talk about, in this one, we're going to talk about a few other things that are specific to stock markets and some, relevant tools, or just a little bit about those relevant tools anyway. So without a further ado, I'll just jump right into the screen and I'll minimize my face so I don't take up screen real estate. So this series, this episode is titled How to Gain Confidence to Trade in the Stock Markets Without Having Any Prior Experience. It's a bit of a mouthful, but you'll see why. Or rather, actually, I'm sure you know why, because a lot of people somehow do not have that confidence yet. And confidence is actually the biggest problem, or the biggest obstacle in the way of people, from becoming an average Joe to becoming a profitable trader. So hopefully this will help you give some additional confidence of trading or investing, depending on what you're into, that hey, this is not gambling. I'm not going to lose money every time, and hopefully that'll help. So now these are the basis, whether you call it the basis or the rationale for trading or investing. So technical analysis is mainly used primarily for trading. Fundamental analysis is only used for investing. The thing is, you can use technicals for investing as well, and you can not use fundamentals for trading because it works on a different time frame. The thing is, both of them work. It's not like both do not work or anything. Both of them will work. You just have to find out what works best for you. The ideal scenario or the ideal combination would be both. So, if you know both, nothing like it. If you don't, then that's fine. We're all here to learn. So this is what technical analysis typically includes: price charts, indicators, oscillators. This is not my image, by the way. Due credit to the website. If I can find it, I'll link it below. For fundamental analysis, you analyze the company, you analyze the industry, you analyze the macroeconomic conditions. So macroeconomic conditions would include the economy, the global economy, what the global economy is looking like. Are we in a recession? And and so on. So that would include that, and the future profit outlook. So what does the future look like for the company, not in terms of the share price, but in terms of, will they continue to be profitable or will they sort of hamper? For instance, Jet Airways, when it sort of began its descent, the profitability did not look good. As a result, it sort of took a tumble on the fundamental analysis part. So when we talk about trading or investing, there are different time horizons, like long term, short term. You've heard of that. What I'll share here is more of trading related, not exactly investing related, because investing is almost always going to be long term. So scalping is a few minutes to a few seconds. Day trading is during the day, whether you take an hour, 2 hours, 3 hours, 4 hours, as long as it's bought and sold within the day, it's classified as day trading or intraday. Positional trading is for as long as the trend lasts. On a broader scale, let's say a few weeks to a few months. Swing trading is, you buy today, you sell tomorrow, or you buy today, you sell after a couple of days or a couple of weeks. That is swing. Investing is for a longer term. Several months is also in these days considered positional trading. So if you're investing, it's most definitely going to be for several years, whether it's 5 years, 10 years, 15, 20, 25, 50. That all depends on you. There are people that I personally know who have invested for 50 plus years. There are also people that have just started investing. So again, it is for a longer term. You can see this sort of timeline that a scalper would take a lot of trades per day. Day trader, several trades. Intra-week, which is more of swing, I'd say, multi-hour charts such as 1 hour, 3 hour, 4 hour charts. A couple of trades every week. And less than 1 year is generally positional traders, and greater than 5 years are your regular investors. And see, now if this sort of thing goes away, I can show you. This is technical analysis, the lower part. I'm pointing towards the screen. I'm sure you can't see my finger though. So the left part, the green part, is technical analysis, and then it sort of moves and transitions into fundamentals. Still, I mean, honestly, this category, at least, this is fine for technicals. Anytime you talk about greater than 1 year, 1 year is also fine. Anytime you talk about greater than 5 years, it becomes difficult to do with technicals, because you never know. Unless you're monitoring very consistently, you will not understand what's happening. So yeah, this is the biggest thing that you need to understand. There's no one best method. It all depends on your risk appetite, your goals, what you're most comfortable with, and what you want to do. Again, there's no point in you looking at trading videos when you want to do investing, or you looking at investing videos when you really just want to become a trader. So you need to make up your mind first. There's no that theek hai chalega, main sab kar lunga. There's nothing like that. You need to understand what you want to do. You need to be clear about that, and you need to tackle it accordingly, because all these five, well, most of these have very different approaches and very different mindsets that you need to tune. I personally am a part of, well, 1 to 4 really, but 5 also. You can't ignore investing these days. These are the types of trends. I have a video on trends alone. It's coming out, or it's already come out, depending on when this episode goes live. Already recorded it, so it's definitely out there. But yeah, we can see that according to the Dow theory, this is this is a bullish trend. Rising tops, rising bottoms, very self-explanatory stuff. Again, I'll link that video in the description when it does come out, so you can check it out. It's a 15 or so minute long one, purely on trends and the basics of trends. We can see here uptrend, sideways, downtrend. This red line is called a resistance, and that we'll come to in a bit. Now, technical analysis, what it entails. Pure technical analysis has little to do with what company you choose, what the financials of the company are, which industry it is in, which market it is in, whether you talk about US markets, Indian markets, crypto markets, FX markets, anything is fine. Technical analysis is a common ground. It doesn't matter which market you're talking about, doesn't matter which stock you're talking about. What does matter is the chart pattern, indicators, and sometimes more information depending on the type of market. For instance, volumes are not available in FX, and depending on that. So now the types of charts, you might have seen charts very often, line charts and candle charts being the most common ones. We'll talk about a few here. So these are point and figure charts, these X and zeros. It reminds me of that game I used to play, sitting on the back bench behind my notebook with friends. So yeah, this is a point and figure chart. This is a Kagi chart. I don't use any of these. I don't even use this. This is a Renko chart. It looks very neat, looks very clean. It is not that easy. And this is a line chart. So again, this red line is resistance, this red line is a resistance, this is a resistance. Again, this is all something that we'll come to. You don't really have to know it by heart, because all of this just comes to you naturally once you've got enough, once you've got enough chart time. When someone learns to become a pilot, it's called flying hours. Now, kitne flying hours ki hai? How many hours have you flown? So I like to say that, hey, how many charts have you seen? How many hours of charts have you seen? Or how many charts have you seen? Because the more charts you see and the more frequently you see them, the easier all this becomes, and it just becomes second nature. For instance, after a point, you just know, like it's instinctive, it's intuitive, and it's very easy. You do not have to worry about this. Now, this is candlesticks, or rather these are candlesticks, and this is something that I use personally. This is a bearish candle. What that means is that it is a candle which shows price going down, and we can see that the wick, so this part is called the wick, this is called the body. Similarly, wick, body, wick, body. Now, this is the high, and this is also the high. This is the low, this is also the low. How they differ is that because a bearish candlestick is one where the price is going down, the upper part is where the price opened at, and the lower part is where the price closed at. Similarly, because a bullish candlestick is a candlestick that goes up, this part is the open, and it closed here because the price went up. So let's say if it's a bullish candlestick, can the price ever open here? The answer is no, because then if it opens here and if it comes down, then it automatically becomes a bearish candlestick. It's a red candle. Essentially, if it's a red candle or if it's a black candle, you can customize the colors, by the way. It opens here, it closes here, made a high here, made a low here. That's all you really need to know. And again, all of this comes very instinctively, very intuitively. So these are a few candlestick patterns. You can find multiple patterns out there. There are entire trading strategies based on patterns, Japanese candlesticks and such. These are just a few of them. We can see here bullish engulfing. What this means is that there was a narrow or a small red candle, a small bearish candle, and a big green candle. What this means is that the price opened here, closed here. The next day's price opened here, but it managed to close all the way here above this high. That's a very important thing. Similarly here, bearish engulfing is the opposite of bullish engulfing. Price opened here, closed here. The next day's price opened higher than this high, but it managed to close lower than this low. So essentially, logically speaking, this case, it would, sort of, you could infer, or, this would imply that the prices are going up. There is more demand, there are more bulls, there are more buyers in the market, which is a bullish sign, hence the word bullish engulfing. Here, selling pressure is high because the price closed here, opened higher, but then it managed to go all the way down. And the prices can only go down when there is selling happening. Again, remember demand and supply. When supply is higher than demand, prices are going to fall, which means that there was selling pressure here, excess supply, and hence prices fell. Not a good sign, negative sign, a bearish sign. These are a few other candlestick patterns that you can look at. Really, it all just comes instinctively. My alarm is ringing, but that's fine. Technical analysis indicators. So these are just tools which show where the price is, heading, where it's at right now, what it looks like on a more macro perspective or on a broader perspective. And this is done using moving averages, like the average of the past few periods, whether it's a simple average which sort of gives a equal weight to all the previous prices, or it's an exponential average which gives more weightage to the current prices or the recent prices. There are several others. Statistical models, you can use many. It's called quant trading. You might have heard of it, very famous these days. In fact, there's a video on quant trading, or rather an interview on quant trading on this channel itself. You can check it out. Historical price data is very self-explanatory again. Historical volume data, again, very, very easy to understand. And there can be separate indicators, overlays. You've got just tons of things that you can experiment with. And I'll show you my personal chart in a bit. And what I want to talk about, about my personal chart is this series and Fibonacci number. So we'll come to that in a bit. But these are all essentially some or the other form of math and price and volume. You don't need to know the maths, you don't need to know the formulas or anything. It just comes directly to you thanks to all these charting softwares. It's very intuitive, it's very easy to understand. So this is an example of a chart. This is a simple moving average 200 period. What it means is that from, if we talk about this data point, this point is generated by the average of 200 previous price data points. This is an EMA, the red line that you see, that is an exponential moving average, essentially 5 periods before, giving more weightage to the current ones. So that's all that it is. RSI, ADX, those are two different indicators. You can look into them or not, doesn't really matter. Essentially what it means is that the indicators are giving you a buy signal. For instance, RSI 50 ADX here, and close above 200 SMA is one of the strategies. I'll talk about it later, also in a separate video. But we can see that it gave a fantastic move on the upside. So you're probably trailing it using the 5 EMA here. That's fine. Now, Fibonacci retracement levels. Now this is very important because intraday pure price action and such, this can help a lot. When you're not using indicators, it can help a lot, and I'll show you how. So, quick little thing, opening an Infosys chart. So we can see here, this is the intraday chart, 15-minute on Infosys. I can use this and I can just draw this like this, and we can see that price took support at 61.8, taking resistance at 78.6 right now. And how this is made is that you are connecting the low to the high. I'll do it again. You are connecting the low to the high, and these numbers get generated automatically. So this is Fibonacci numbers. You can just Google them and you'll find plenty of material, but this is all you really need to know to start with. You know, as you progress, you can always learn more, you can always understand more. Fundamental analysis. There's a lot that can be spoken about here. I personally don't do fundamental analysis because I'm too shit at it, but if that feels better for you, please go ahead with that. But these are some things that you can use for fundamentals. Again, this is all very easy to understand, no rocket science at all. And I'll just give you a few seconds to look at this. No point in me talking about it. Essentially, it talks about business factors and, you know, conditions, and not related to the stock price at all. Fundamental analysis really does not talk about the stock price that much as it does about, you know, the company itself, the industry itself. Fundamental analysis will only really consider the stock price when you talk about how the company looks like relative to what it is trading at. So that's something important to keep in mind. But these are some things that you can look at, very easy to understand. Company data, analysts could look at EPS, earnings per share, price earnings ratio, PEG ratio, return on equity, dividend payout and yield, multiples like, you know, your revenue multiple, EV multiples, EBITDA multiples, all sorts of things. You can check this out also to see how capital flows and how you, if you're into this finance stuff, please pause the video, check it out. I don't want to waste time just talking about this. Industry analysis, compare the results of industry as whole. Financial information, you know, what the industry is looking like. For instance, when how can I give you a better example here? When mobile phones came out, landlines as an industry were lagging behind. That's one way to think of it. So again, it's very easy to understand. It's all very intuitive stuff, but you can just check this out. Now, value investing. This is a buzzword, Warren Buffett, value investing, all of that. Now, value investing involves picking stocks that are trading for less than their intrinsic value. Intrinsic value is what the company is inherently worth, you know, using calculations, using money, how much the company is valued at, you know, in terms of what they own, not in terms of what the share price shows. So the aim here is to get multi-baggers. Essentially, you're looking for, you know, multiples like these, models like these, FCFF, FCFE, simulations, EV multiples, all of that. And again, these are all used for fundamental analysis, value investing and such. I personally do not use these things at all. And global environment, you know, trade war, recession, treasury yields. Again, this gives you an idea of how old this presentation is. Apple manufacturing in India, all these events, massive impact on the markets. Very easy to understand. Macroeconomics, I don't want to sound like your economics teacher, but this is what it looks like. You know, these are some indicators that you can look at, and this is what's used. Housing starts and such, primarily used by US analysts, but again, no harm in using that, no harm in knowing about that. And that's it for this one. Now, this is the topic of the next episode in the series. So if you liked this one, make sure that you like it. If you did not like it, then just let me know and we can see how I can improve it or something. But I'd like to share this with someone. Please go ahead, you have my full permission. That's it for this one. See you in the next.